Welcome to the latest episode of High Stakes. I'm Paige Soya, Managing Director of K Street Capital. And today's episode is going to focus on some of the pros and cons between M&A and IPO and some of the various scenarios that can happen in either case. And we've got two incredible people on our podcast today. One being Rob Schwartzberg, who is one of our investors at K Street, and his longtime comrade, Darren Womer. And before we kick it off, I'll let you guys introduce yourself. Rob, if you want to go first.
Sure. Thank you, Paige. I am a former partner at FBR, now known as B. Riley FBR. As a former investment banker, I was closely involved in taking over 15 companies public, as well as approximately 30 follow-on equity and high-yield offerings. During my most active year, FBR was the number one IPO underwriter in the United States by volume. I primarily invest for my own account right now in public equities for the past 23 years across a variety of industries, including technology and fintech. Did my undergraduate at Georgetown in finance. I have an MBA from the Wharton School in entrepreneurial management. I've been an angel investor and board member at a vending technology company, which was sold in May of 2023. And I'm very pleased to say that I am a member of K Street Capital, and I've been very impressed by Paige and her team in terms of their expertise and thoroughness. And with that, I will
Thank you, Rob.
you're welcome. I will turn it over to Darren.
Hi, everybody. I'm Darren Womer. I've been doing mergers and acquisitions and investment banking now for 40 years, believe it or not. I started when I was in my early 20s and started out with a Wall Street firm in their accounting and compliance department and quickly realized that operations was not for me. So I struck it out on my own and put together a group of ex-business school fellows, and we formed a merger and acquisition group in the mid 1980s. And I did that for approximately 10 years, very successfully. Most of the activity was mid-Atlantic based companies, small to mid-size, and had an opportunity to join National Capital through a mutual lawyer who was a good friend of both firms, and joined National because of the expertise of the partners. They were former Deloitte executives, had a lot of public company experience, and I wanted to get back to being able to do work with public companies and raise capital legally. So they had the broker dealer, and that was an attraction. So I've done that since 1994 and acquired the company in early 2000 and have had a successful 20-year run since.
And you forgot to mention, how many M&A transactions have you done in
Oh
the 40 years?
God, this is a rough estimate, but no less than 200 transactions that I've managed and or
Wow.
participated in. Having now a team of 12 investment bankers on my platform, sometimes I'm involved directly and other times just doing oversight. But yeah, at least 200.
And you're still standing. It's amazing.
No, I'm falling now. It's blend that in with capital formation, early stage companies like the ones that Paige, you and K Street have done. That's sort of been more of a latter part of my career interest, as well as we continue to do merger and acquisition work.
Yeah, and I know I've said this before, a lot of our audience knows I've been involved in a number of our M&A transactions, about 8 of them, pretty heavily, with bankers, of course. But even going through those 8, I can't imagine the number of gray hairs that I got from those 8. I don't know. I wouldn't be standing after 200, that's for sure.
Well, it's over a long period of time, but you're right.
Well, I guess why don't we start, Darren, with you with some of the things to consider when exiting via M&A. And Rob, feel free to interject. We both may interject in the middle of some of these things, Darren, but I'll let you kick it off.
The most critical thing is that the principals and the shareholders are motivated and interest aligned to proceed, because without that, no matter how good the banker is, you're not going to be successful in the end. And having reasonable expectations is also extremely important. And if you do your job right as an intermediary, you're of course going to exceed those expectations, which I think happens most, if not all the time. So running a process, in my view, even though that's what we do for a living, I think is critically important to really having success at the end, and can go into the details behind that. But
Just to clarify for everyone, you're talking about a banking process, a proper formal banking process.
the one thing you can't get rid of if you use internal resources is that interaction with the buyer candidate portfolio that you've developed. And that puts you at a big disadvantage when they see and hear every reaction you have along the way. Whereas if you have a third party, they can really shield you and really help get maximum value out of the transaction.
Plus, most small to mid-sized companies just would never have an internal team that would have the bandwidth to focus on that in the first place, based
No,
on my
they
experience.
no, they don't. And even the bigger companies, I think oftentimes, even though if they have an internal team, will hire a banker just to be able to, even if it's a sell side, if it's a corporate orphan, which we've done in many circumstances, you have a big company selling off assets, they can't be distracted with all that goes on, reaching out to all the investor candidates, putting together a book. It's just not a really good use of their time. But certainly for the smaller companies, they need not only the bandwidth, the time that it takes to be able to do it, they need the expertise along the way to know when not to give information that's being asked and when it's appropriate. So I think there's a lot of value to be made by hiring someone. The only time you wouldn't do it is if you had a premium strategic bid that came in artificially and you just knew that this offer was not really realistically going to be achieved by going out and doing a process. And if you're able to get that and quickly get them committed, then you could simply use your outside law firm to guide you along the way.
Rob, were you gonna
I
mention
was just
something?
going to expand on 2 points a little bit. I mean, as a founder who's working 80 hours a week, maybe in some cases, or a CFO of a startup or growth company who's maybe working 50 to 80 hours a week, you need to ask yourself, do I really have an extra 20 hours a week for the next 4 months? And what
At
other
least.
opportunities am I going to miss? What things are not going to happen because there's only one of me that, there's only so many hours, so think of it in those terms. I think sometimes people think, well, it's another hour a day out of my life. No, really, it's a team of about 3 or 4 people working between 10 and 40 hours a week for probably 8 to 12 weeks. You'll kind of know what you have on your hands. And so when you put it in those terms, do you want to go to 110 hours a week and probably end up with a lower result than you would have if you'd not done that? That
Right.
doesn't make full sense. And the only other point I would make is, as a former board member, I appreciated having a view into the process away from the founder, because sometimes the founder has certain views of the world that might not be how the outside world actually views the company. So I like the objectivity of
Yep.
an advisor as a board member.
Well, on that note, Darren, maybe share a little bit about what the process is like, how long it takes, and how much it costs, and then I'll add a few things in there as you go.
Well, everybody knows cost, but they don't know the value, right? Until the process goes through. But it's about 6 to 12 months on average, 9 being like your typical pregnancy. It's a good average, but it can certainly be shortened if there's a preemptive bid. It can be extended if the process doesn't go as well or valuation expectations haven't quite met, and it can extend. But I think 9 months has been a good average for our sell side transactions.
And I will
Cost,
say that I think that's pretty consistent with what we've seen.
I mean, the cost is going to be typical for any solid intermediary investment banker. There's going to be a retainer because there's a lot of time put in, as Rob mentioned, particularly in the first 3 to 4 months. So there's a retainer. We typically break that up into monthly just to make it affordable for them. And then there's a market success fee at the end, which can vary depending upon the enterprise value. And the retainers are credited back against the success fee.
So I would just add that we have seen a lot of cases where companies think that they're ready to transact, but they're not really, but they hire a banker at least, but then they start going through the process and realize their financials are just nowhere near, it's just nowhere near ready for this. And they get 6 months into it or whatever, and they might even have some bids. They can't go through diligence. They can't actually do any of that. So they end up dropping the whole thing. And then of course they have to wait quite a while because it takes them time to get all these ducks in a row. And at that point, you don't want to come back and look like an old deal that all these buyers have already kind of seen. That doesn't look great. So then they wait a few years and then do it again. And this happens more often than I think people would expect, especially with early stage venture backed businesses that get to that mid size.
I was just going to add, we're going to touch on the IPO process later, but what you said about companies thinking their financials are in order versus whether or not they really are ready for prime time goes doubly for IPOs, because if they won't make it through a M&A due diligence, they won't make it through the SEC. And the number of times I've seen somebody try to go, file with the SEC, and then it turns out that something was wrong or improperly accounted for, and then they have to keep going back multiple times. So I know we're going to touch on it later, but it's even more important for the IPO process to really have your financials in order prior to beginning the process.
100%. And Darren, like you may want to speak to this too, but I've also seen like companies that do have their ducks in a row and they are super organized and their financials are great. It's a lot easier for the bankers. And as a result, often once you get in there, that upfront retainer can be a lot less with certain bankers because they realize that the level of things they're going to have to deal with is a lot less. Now, most companies don't fall in that bucket, but some do.
Yeah, I think you can always be flexible on the retainers if it has an impact on their budget. Regarding the financials, we wouldn't take on an account if those financials weren't really up to date and in prior years at least reviewed. And if they hadn't been reviewed, we'd suggest that they go back to their accountants and make that step. But for really early stage companies, sometimes the financials aren't the most critical piece. It's really the IP, the customer traction, and where they're capturing business and perhaps the buyer's losing because they have an inferior technology or solution. So it's really all about the future for some of these buyers who can take a risk on the smaller companies if the technology is mission critical to where they want to go.
I think that's 100% true. So, Rob, things to consider when you're exiting via an IPO, this is everybody's dream, right? Everybody thinks this is going to happen to them, but it's so much more difficult and complicated than anybody realizes.
Well, I would definitely agree with that. I understand we only have a few minutes, so I'm going to try and to distill things down to what I consider the most important. So I'm going to talk about three things. Number one, things to consider before going public. Two, how to select an underwriter. And three, what are the advantages and disadvantages of going public? And in terms of number one, things to consider before going public, the first thing as a founder that you need to think about is public investors only care about future growth. They're buying your future growth in revenues, earnings, perhaps development of IP, but really as a public company, the IP should be pretty well developed already and you should be monetizing it. So in terms of future growth prospects, I think as founders, you need to be very honest with yourselves in terms of, do you have secular tailwinds or a clear, tangible path to significantly above average growth for the next 3 to 5 years? Do you have multiple growth drivers or a pipeline of either new products or new market opportunities? As an aside, public investors despise one product companies. So the more that you can position yourself as having multiple growth drivers, the better off your IPO will be. Other things to consider before going public, tradable market cap. Technically, for the SEC or for NASDAQ, the minimum's 40 million for an IPO. But I would strongly suggest that you really think in terms of having a public market cap that's a tradable market cap of 100 million. And since you're probably not going to want to sell more than 20% of your company in an IPO, then you're going to be thinking in terms of a 500 million post IPO market cap. So that's on the larger side. In terms of thinking about things before going public, do you think you're going to have a 500 million market cap? Because the regulatory burden, the cost, the management time, holding investor meetings, it really doesn't make sense if your public market cap is under 100 million. And then the last thing is more subjective, but I would strongly encourage you to think of this as the beginning of the journey. Going public is not the end game cash out opportunity. It's a journey that could be 1 year or it could be 100 years, but it's not usually 1 year. It's usually 1 to 10. So don't think of this as the end game. It's not the touchdown. It's the beginning of another game. In terms of how to select an underwriter, I would say that you need to be very careful. There are a lot of I'm going to consider myself a recovering investment banker. and tell you that a lot of investment bankers get brownie points for telling their bosses that they have a very active pipeline, but they don't lose any brownie points if they don't convert their entire pipeline. And the company you don't want to be is one of those companies in the pipeline that didn't get converted into an actual initial public offering. So a lot of bankers will say they can do it, but you need to take extreme care in selecting a banker that specializes in your industry and has a proven track record specifically in your company and really understands the technology and understands that growth trajectory process. The example I use is you wouldn't go to a foot doctor if you needed brain surgery. You would find a brain surgeon. So really specialize and focus in on those specific underwriters. And in terms of underwriting, it's critical to understand who your future investor base is going to be. How are the shares going to be placed? What you want to make sure is they're placed with long-term holders who understand your industry so that when the market gets choppy, you don't have to hold the hand of 100 investors calling you every time there's a single tick of the stock. If you don't want to place it with the short-term investor who doesn't know what your company does, it's a symbol, and they're going to be out of your stock by the end of the day of the first day of trading of the IPO. That's not the investor you want. So take real care when you're interviewing underwriters to determine how your shares are going to be placed. And now, in terms of the advantages and disadvantages of going public, broadly speaking, being public makes everything better on the upside. It makes everything worse on the downside when you fail to deliver on your objectives. So just in terms of the upside is obviously greater access to both debt and equity markets, right? Instead of an investment community of, let's call it 50 VCs, well, now you've got 2,000 potential institutional investors all over the world. So vastly greater access to the market. Due to the enhanced liquidity, you're probably looking at a higher valuation relative to the similar private company, maybe 20% higher. Being public gives you a way to incentivize your key employees, gives you a currency if you want to buy other companies in your industry instead of using cash. I'll just give you one quick example. Let's say you're a private company, you're worth 400 million. You've got, let's call it 10 million private shares. You're worth $40 a share privately. That same company as a public company probably worth $48 a share. And if they're approached by one of Darren's clients and they say, listen, we'd love to buy you for 49, you can now go to them and say, well, obviously we wouldn't do that because in a strong market, our stock could be in the mid 50s in a year. So if you come in with the 60, well, maybe we have something to talk about. You're not in as much of a position of strength as a private company to have that negotiation. Let's talk about the downside. The flip side of a higher valuation when you're public is it will be your worst nightmare if you fail to meet your objectives because your failures will be instantaneously communicated all over the world. There's obviously public scrutiny of you personally. Any intercompany transactions that you consider innocuous will be highlighted in any sort of public filings. So any personal issues in your past will be probably brought up by someone seeking to profit from the shares going down. So, we discussed an example yesterday where we were about to take a company public and a more enhanced background check turned up a conviction for meth production by the CEO. So we canceled the offering. So it was a supposedly youthful indiscretion for someone who was under 18, but it's not a risk the underwriter could take. So things like that could potentially come out when you're public.
I was just going to say, I think that, I'm no expert on IPOs, but the way I always think about it for the sort of like layman's terms is it's really like another fundraise. It's like you're selling part of your company to the public market and turning all your shares into public shares, but it's like a fundraise that you're just under a lot more scrutiny and you need to be a lot more confident about what you're going to deliver. Whereas in venture, oftentimes in Series A, B, C, even D rounds, like you may not really know what you're selling your projections because you hope that you'll meet them, but you don't really know for sure that you're going to meet them. You don't really have that sort of 90%, 100% confidence level. Whereas when you're doing an IPO, that's a fundraise where you really kind of want to be, super confident, and there's a lot more hoops to jump through. But if you are confident, then that's potentially a path. At least that's how I think about it.
I think
Tell me if I'm wrong, Rob.
No, I was going to say you're thinking about it exactly correctly. Let's say a company does a Series B based on certain projections, and they fall short. The Series B investors maybe aren't happy, but they're still in the company and they're
Yeah.
going to try to help improve things. Um, that same company, that stock could be down 50% when they announce the results of failing to meet a certain product delivery schedule or something like that. Whereas in actuality, the fundamentals would dictate, well, okay, it's maybe worth 10% less. People will press that on the downside. Stock then spends a year in the penalty box. Meanwhile, key employees whose options are underwater start to think about other opportunities. So it can be a great option, but you really need to be honest with yourself about your ability to meet the objectives. And there's virtually no tolerance for failure, you know.
Yep. Rod, the other thing I was going to ask is, do you have experience with international IPOs, like other countries outside the US, companies going public?
A little bit, but not a lot.
Yeah, I wanted to bring it up because I think there's this interesting trend that I see sometimes. It's not that big of a trend, but it is something people consider as taking their company public in a different country because it's easier. It's a lot easier than in the US, and it doesn't need to be as big. And I don't really see a whole lot of value in doing that because I think there's just a sort of reputation of going public in the US is completely different. It's a completely different process and it's a lot more serious. But I know there's people out there that consider it
Well,
about.
I would just say that, I made a point about the investor base is critical. And so when you do that, your investor base is overseas. And I'm not really sure you get the benefits of being public because you're going to have to completely change over the investor base to a US investor base if you then want to go and raise new public debt or equity in the United States. So then, that it's going to take some time. You don't turn over your investor base in a month. That's a multi-year process. So I'd probably recommend against is I'd take the time to go public in the United States the right way.
The last thing I was just going to say is between the two of you, be curious your thoughts for the founders out there and the investors out there that are invested in these companies that are thinking about an exit. And they may be at that 500 million plus valuation legitimately. And they're trying to decide between going down the public path or going down the M&A path. What would you recommend to them? Like how can they decide which one's the right path for them? Or are there cases where they should be pursuing both at the same time, potentially?
I mean, I've been in many situations where both paths were pursued on parallel tracks.
Well, exactly. When you file your S1, Rob, you pretty much are putting out there everything that anyone needs to know about your company. And it can oftentimes lead to a unsolicited bid that maybe exceeds the expectation of ultimate liquidity for the owners, which usually
That's
comes in
interesting.
secondary offering. It happens all the time.
And can I just add to that? There's also time of, okay, the bid emerges based on the filing, like you're saying. I've seen that. And then it's like, whoa, it's the bird in hand kind of, we can be public and, have a market cap of 500 million. These guys are offering 650. Do we really think our stock is going to be up 30% in the next 18 months? And what are the other advantages that this potential buyer brings that we don't get? Plus, we're not sure our product is going to, you know, we know it's going to work, but it might not work in the next 3 months. So maybe it's better to be part of this other company. So yeah, you're always making the decision in the best interest of the stakeholders. And when the buyer is willing to pay a meaningfully higher number than the expected appreciation on the stock, then that's the offer you have to take, especially over a short time frame.
And Rob, at what point on the IPO path can you not turn back, or can you turn back at any point? Because I guess I'm just wondering, like, how does that work for the underwriter or all the people that you've engaged in the IPO process that then you get a strategic bid that comes in, you decide you're going to go that direction and the whole thing falls apart?
You could at 11:59 before, anytime before the public investors actually, buy their shares. I mean, within 24 hours of actually closing an IPO. I mean, the underwriter is, they're lining up, let's call it 200. They have a book, and these people have they've done a lot of due diligence. Um, let's use the example. They're ready to buy 100 million worth of stock for a company that they think is going to be worth 480 million. So they've done some work, and then this bid comes in at 650. The board is legally obligated to take the 650 unless they really think their IPO is going to trade to a billion or something. But most likely their fiduciary duty is to take the 650, and the investors who've done the work but haven't actually closed will not be super happy with the underwriter, but that's just life.
Yeah. Okay. So there's no clawback clauses that the underwriter has. There's nothing like
There
that in
could
the
be a breakup
process where,
fee.
Yeah.
There could be a breakup fee.
Yeah. Yeah.
but it's not so extraordinary that it wouldn't stop most people from taking a better offer like the one you described just now.
No.
Darren, do you have anything to add to that?
I mean, Paige brought up the foreign exchanges, maybe referring to Toronto or London. And I agree with you, Rob. That would typically be a mistake because where you're going to get the aftermarket support. And that's the whole point of going public. But I
Give
mean,
you
just today, fewer and fewer companies are going public just because of market conditions and size requirements. So for most early stage companies, it's so far off. It's really, they shouldn't think of it that way. They should just think about what do we need to do to grow the intrinsic
Have a great
value of this.
business.
Yeah,
Exactly.
that's it.
I was just going to add, so I told you I'm a very active public investor, and I own shares in a company, Linde, which is an industrial gas company that is based in Germany and traded on the German exchange. And I generally have a pretty high opinion of European regulatory framework. But the stock, when it moved from the German exchange, from the DAX to the United States, it still popped about another 10% just by being tradable in the United States, because we're just such a much broader, deeper market. And so I think there is something of a preference. So if you can help it, I wouldn't start overseas.
It's a weird thing that I've seen. It's like US companies that go overseas. And I think because they're not eligible for the US process. To me, it's a signal that the company is not good enough to do it in the US, but they just want to go public for one reason or another. So they try to do it on some other exchange. And if people don't know any better, they just think, oh, your company went public and that's great. And they don't understand the difference. And I think the perception there is not always recognized. It's a
Well,
big difference.
this kind of what I was getting at before is going public is really part of establishing a relationship with the public markets to raise future expansion capital at a cheaper cost. It's not its own end game to be able to be at a party and say, well, I'm public, in Germany, whatever. So if you want to be able to access the US markets, you need to have an investor base in the US that you can go to and that has familiarity with your company.
Cool. Well, thank you guys so much for being willing to do this. Got a lot of takeaways from this conversation.
Great. I learned a lot, Rob, about the IPO market. No,
I learned a lot about the
so-
M&A market. So thank you, Paige, for having us on.